Welcome to Behind the Advice, the podcast for Australians living abroad who want to maximise their financial situation. I'm your host, Mitchell Kelsey, a financial advisor at Runway Wealth Management, and in each episode, I'll be sitting down with other experts and professionals to get their insights, stories, and expertise on key concepts for Australian expats, as well as providing my own perspective. With this being a financial podcast, there is a disclaimer, so any information that you hear in today's episode is general information only. It is not personal advice, so it does not take into account your personal situation, goals, or objectives. If you do need personal advice, feel free to reach out to us at Runway Wealth Management for personal financial advice. Welcome back to another episode of the Behind the Advice podcast. Today's episode is all about investment planning for Australian expats in 2026, and more importantly, how to think about investing as an expat through the lens of tax, structure, residency, and long-term planning while you're living abroad. In this episode, we'll be talking about how the expat investment landscape has evolved, the common traps Australians fall into while investing as a non-resident, and how to get the foundations right can make all the difference. Today, I'm joined by Tara Buchanan, Managing Director at Worldwide Advisory. Tara is an accountant and tax specialist who works extensively with Australian expats, helping them navigate complex tax matters and residency issues. So great to have you back on for another episode, Tara. How are you today?
Yeah, I'm good. Thanks, Mitch, and thanks for having me again.
Fantastic. Let's kind of give listeners a bit of a quick overview in terms of your backgrounds and how you support Australian expats.
Yeah, so I run Worldwide Advisory, and we special in cross-border tax for Australian expats and globally mobile clients. What makes our work a bit different is we don't just look at, investments in isolation. We look at the full picture. So that's personal tax residency, but also business structures. A lot of our clients are running businesses across borders. So we're dealing with things like where the decisions are actually being made, central management control, whether there's a permanent establishment risk, etc. But also making sure transfer pricing is aligned. And we also provide resident director services. That's just one of our latest product offerings, which has been quite popular. It's becoming more relevant as people expand globally and need that real substance offshore. It's really that intersection of personal and business, which is where most of the issues actually come from.
Yeah, absolutely. And I think for us, from a financial planning standpoint, we're mostly focused on the individual level and individual tax residency. But I think certainly from a business standpoint, that's a whole different ball game when it comes to managing your business across borders.
Yeah, 100%.
I think just to get started with today's topic, it is investment planning as an Australian expat. So I guess from your perspective, have you seen the investment landscape for Australian expats change much over the last few years?
Yeah. In all honesty, it's expats, they're not simple anymore. I mean, not that they're very simple, but it's getting more complex. It used to be just someone working overseas on a salary, whereas now people are investing, running businesses, trading, setting up offshore entities and so forth. But at the same time, regulators have caught up, and we've now got this dual layer where it's not just where do you live, it's also where is your business actually being run from, and that's where a lot of people are being caught out.
Yeah, absolutely. And I think certainly tax reporting, tax burdens have certainly increased over the last couple of years. And I would even say there are even fewer kind of investment platforms available for Australian expats to use than there were maybe 5 years ago. I think certainly a lot of particularly Australian platforms have kind of cracked down on Australians using an investment platform when they're a non-resident for tax purposes. That's something that I've certainly seen quite change rapidly over the last couple of years. I think where we might start off is just touching on residency and how that really drives a lot of the investment strategy for Australian expats. So I think from your perspective, Tara, why is tax residency kind of the cornerstone when it comes to setting up an investment plan for Australian expats?
It flows into everything. It's at the individual level, it determines what Australia taxes. We're talking income, capital gains, and all of that. Where people underestimate, it's on the business side, because your personal location can actually pull a company into that Australian tax net. So if you're sitting in Australia making decisions, even if the company's offshore, that can create issues. So it's not just personal, it's structural.
Yeah, absolutely. And it really is central. Like, it is the cornerstone to how you should really go about managing your finances more broadly. You know, your tax outcomes are completely dependent on your tax residency status in Australia. So I think really understanding that is a really great place to start before you even think about investing. Understand whether you're a resident or a non-resident for tax purposes.
Yeah. Well, if you don't have that right, then, the advice that's built on that, um, whether you're a resident or not, may or may not be correct because, yeah, you need to get that right first.
Yeah, absolutely. Have you seen any, I guess, notable changes in how the Australian Tax Office views expats from a tax residency standpoint? I think in the past, we've had several proposed changes to the tax residency rules here in Australia. So at the moment, we have those 4 tests. At this point, those 4 tests still remain the current tax residency rules, and how you apply those determines your tax residency status. Have you seen any notable changes in terms of how the ATO applies those to an expat situation?
Yeah, they're becoming a lot more sophisticated now in terms of, I guess, the questions they're asking, but also data matching, whether that be through immigration or data sharing agreements between countries. The ATO, they're not just looking at where you say you live, they're looking at your behaviour, the data, where the decisions are actually being made and how money flows. And, from the business side of things, there's a massive focus on the central management and control, CMAC, and permanent establishment. So it's much harder now to have a structure that doesn't reflect reality. And the ATO are really cracking down on the substance over form. A rubber stamping of a document isn't suffice. They're actually looking at what is actually happening, not what just you're saying is happening.
Yeah, sure. And I think gone are the days where you could kind of just move abroad and still have quite loose connections with Australia and still be considered a non-resident for tax purposes. I think you really need to have a robust case to support your, I guess, determination that you're a non-resident for tax purposes, because if it does get kind of queried by the ATO, you want to have the evidence to support that.
You do. And I think there's also, what I always say to clients is where there's, we're a tax agent, we provide an opinion. At the end of the day, it's the ATO that has the final say. So if you are wanting 100% certainty, we need to look at a private ruling path. Submitting a private ruling application to the ATO is actually no cost of submitting that. You've got the tax agent fees and our advisory fees in preparing that onerous document, but it's 90% of our clients are kind of going through the substance of what's happened, but where there is, for whatever reason, whether it be due to millions of dollars of investments or risk factors, we may be looking at a private ruling path to get that 100% certainty from the ATO at the start.
Yeah, definitely. I was actually speaking with some clients in the UK the other day that went down that route of getting a private ruling. They just wanted that certainty in terms of how their investments were going to be taxed from an Australian standpoint. Are you seeing many Aussies that are departing Australia applying for those? Has that kind of been increasing in terms of the interest for those private rulings?
Yeah, it has. It's twofold. We've had a lot of I think it's the 482 Kiwis when they come into Australia wanting certainty around the fact that their foreign investments aren't going to be taxed when sold. But at the same time, yes, we have had those who are departing Australia wanting certainty around the valuation date of assets when they leave, because they don't. It could financially potentially ruin them if the ATO came back and said, no, we determine a different date where the deemed disposal amount is higher, taxes are higher, so forth. So we are seeing it increase. Probably the last 6 months has increased exponentially. But it's yes, we are seeing it a lot more.
Yeah. And I think Tara, we don't mean to scare listeners in terms of, you need to kind of go down the route of getting a private ruling if you want to be a non-resident for tax purposes. We're just saying you need to kind of have that robust case and your circumstances really need to match that of someone that is living overseas on a more permanent basis, or at least the intention is to be overseas for a longer period of time.
Exactly. And intention is, a big thing with the ATO. It's, yes, they're looking at substance over form, but they're also looking at what your original intention was. Because we do have people, I've had a couple of clients that have questioned me about moving back from Dubai in the last week, given the political climate.
Yep.
And it's talking them through, well, no, your intention was to indefinitely stay over there. Beyond your control, circumstances have changed and you are coming back. So it's kind of going through that, providing them with, what their situation looks like, and whether it is worth applying for a private ruling. In most cases with these clients, it's not, because it's pretty, shouldn't say straightforward, but we've got a very strong, robust case that we could argue
Yeah.
with the ATO if they have questioned.
Yeah, excellent. Excellent. Let's kind of get into the investment landscape or investing as an Australian expat in 2026. So from your perspective, I guess from a tax consideration standpoint, what are some of the biggest tax considerations Australian expats need to be aware of before getting started? And it's worth me noting as well, when I'm talking about investing, this could be investing in anything from, shares, ETFs, managed funds, real estate, cryptocurrency. What should expats be thinking about before they even start investing from a tax standpoint?
Yeah, so I guess where they're thinking of leaving, obviously once they've already left, it's a bit of a different conversation. But where you're thinking of leaving, it's realising that Australian property, taxable property, is always taxable in Australia. It doesn't fall within the net of what's called deemed disposal, which we, I think, touched on last podcast.
Yeah, we did. Yeah.
So property is always taxable, and then everything else that doesn't have an underlying, I guess, property, heavy property focus. So we're thinking investments that
Like real
their
assets.
underlying assets are all property,
Yeah.
so that they are included in that property net.
Yeah.
But where you've got shares, foreign property, crypto, anything like that, we do have that option of doing the deemed disposal upon departing Australia. If investments are held in, say, a trust and you depart Australia, then there's no option of deemed disposal. It's automatic. You have to do it. But it's around having that conversation with clients. Okay, what assets do you hold? Okay, well, this is the tax implication if you sell them before you go. This is the tax implications if you sell them after you go and you don't do deemed disposal. And this is the tax position if we take up deemed disposal upon you departing. With the, property used to, be, I guess, the one thing that everyone went, oh, yeah, no, we're I shouldn't say safe, but that's going to be a great outcome for us. But the reality is you lose the full CGT concession, it's the non-resident tax rates and things like that when you do actually sell it.
Yeah, absolutely. And you raised a really good point there. There are considerations for expats when you move abroad and you hold assets already. So you need to think about deemed disposal on your assets that are considered non-taxable Australian property. As you said, it doesn't apply to assets considered taxable Australian property, which are your real assets, like your former home or an investment property that you might have. And then I think once you've moved abroad, if you're looking at different investment options, they'll broadly fall into one of those two categories. So non-taxable Australian property, which are things like your direct shares, your ETFs, managed funds, cryptocurrencies. And then you've got taxable Australian property, which is your physical assets, so your investment properties, commercial property, and the like. And they each have very different tax outcomes from a capital gains tax standpoint, once those assets are ultimately sold, but also how the income from those assets is taxed. That's also very different depending on whether they're taxable Australian property or non-taxable Australian property. So that's particularly for myself as a financial advisor, those are the two main, I guess, asset classes that we're considering for our clients that are looking to build wealth. And there's no perfect solution in terms of investing in shares or investing in property for Australian expats. Ultimately, it depends on your personal circumstances, your long-term goals and objectives. In a perfect world, you've probably got exposure to both for the most part. But I think how you lean into one asset class over the other can kind of help you maximize your situation as a non-resident for tax purposes.
Yeah, no,
And
definitely. And I think it's important to remind people that with deemed disposal at the individual level and obviously excluding the taxable Australian property, it's an all in or an all out. You can't pick and choose the assets
yeah,
you want to take up the deemed disposal on and others that you don't want to. That's not how the system works.
yeah, absolutely. You can't just apply deemed disposal to one allotment of shares and not the other. It's got to be applied across the board. So that's a really good
Yep, definitely.
clarification. And when we think about investment considerations when you're moving overseas, so for someone who's moving overseas, temporarily, or compared to someone that's moving overseas on a more long-term basis, how should they be kind of thinking about, I guess, investing, but also from a tax perspective? How should they be thinking about investing when their stint overseas might be more temporary as opposed to more longer term?
Yeah, I think that, it comes back to, I guess, intention again, where for a lot of people, they do a temporary move, but there is a point in time which needs to be identified if they stay long term, because that's the point in time which, your intention changes from being a temporary non-resident to a permanent non-tax resident. So if you're a genuine temporary departure from Australia, then you're usually still quite tied to Australia, both personally and from a business control perspective. I'm thinking things like I have one client who is in the is it Canada or US. They're doing they've gone over there to do a master's, and once that visa runs out in 6 months after they finish their master's degree, they can't stay in. Oh, it's Canada because they can't stay for more than 3 months afterwards.
Sure. Yeah.
And for them, Australia just sees them on a study break. They're still an Australian tax resident in this particular circumstance for this particular client. Long-term expats have more flexibility, but they need to actively manage things like where decisions are made and whether they've created a presence somewhere else. And then if you're never coming back, that's where you can really step back and reset everything, both personally and structurally, and build it properly from that global perspective.
Yeah, absolutely. And it comes back to tax residency, as we were talking about before. So if your intention is to reside overseas on a more temporary basis, you're still likely just going to be a resident for tax purposes. And not a lot really changes then from a tax perspective, or how you should be going about managing your investments. Certainly if your plans shore up and you want to spend more than 2+ years overseas on a more permanent, medium-term basis, that's when you can start thinking about how to invest and maximize your circumstances as a non-resident for tax purposes.
Yeah, definitely.
And then I think in that last category, if you're someone who is just intending to reside overseas and retire in that country, then you really want to start looking at some of the local retirement vehicles, investment options, tax advantage structures. That's where you kind of leaning more into your local country in terms of what's available. Might still have some affairs in Australia, but you certainly want to be trying to maximize your situation in that overseas jurisdiction.
Yeah.
Let's move into investment structures. So, here in Australia, there are some really popular structures, company structure, trust, family trust, discretionary trust. From a tax perspective, for Australian expats, what investment structure tends to work best, or what do you kind of see as the common investment structure there?
My favorite answer is it depends. The key thing is the alignment. So when we see people set up offshore companies or structures, we sometimes see that they're still running everything from Australia. And that's where all of the problems start to unravel. So whether it's held personally or through a company, the structure has to match the reality. And again, it comes back to that substance over form. Where are you? Where are the decisions being made? And how the business is actually operating.
Yeah, absolutely. And certainly if you're operating as a business, you want to have all those structures in place, not just for tax optimization, but for income streaming, asset protection. There's a few other, considerations that need to be thought about from that standpoint. I think from an investment perspective, if you're just looking to invest in some ETFs or some shares or even property, for the most part, you want to keep things simple. Like there's really no need to kind of overcomplicate your tax affairs by using, various structures in Australia. And in fact, it can be more tax effective to kind of keep assets in your personal name. As we touched on before, non-taxable Australian properties such as your direct shares, ETFs, managed funds, these fall outside of the capital gains tax net of the Australian Tax Office alone. So there's no need to really try and change that ownership structure and be tax effective through a different structure. Again, this isn't a solution for everyone, but just kind of simplicity is something you want to keep in mind when it comes to structuring your investments.
Definitely. And I think, simplicity does win most of the time. It's the issues we see frequently is when people have overcomplicated the structures with no real substance behind them, just for the sake of doing it. And, as we touched on earlier, gone are the days where setting up foreign structures meant, things were offshore, things have really tightened up. Having that foreign structure doesn't necessarily provide any tax minimisation this day and age, especially around the CMAC and PE rules. But if you've got a simple structure that reflects what you're actually doing, then that's usually the most effective way to go.
Yeah, absolutely. It's worthwhile. Let's touch on superannuation as an investment as well. And I should clarify, superannuation itself is not an investment. Superannuation is a tax-effective environment that you can invest through. But superannuation is certainly a significant asset for a lot of Australian expats that are moving overseas. Sometimes it can be seen as a bit of a set and forget asset. So for expats, in terms of what they should be reviewing when it comes to their superannuation, I think ultimately you want to make sure that your investment options are aligned with your longer term financial goals, your longer term retirement goals. What I mean by that is we don't want to be invested too conservatively. If we've got kind of a really long investment time horizon, generally you cannot access your superannuation until at least age 60. And even then there are some requirements before you can access super. So for most accumulators that are still employed, you've got that really long investment time horizon. So don't want to be too invested overly conservative. I think also looking at your insurances. So there's a lot of super funds that provide just a default level of insurance cover. So just making sure that's still valid as someone living overseas. Probably something within the realm of superannuations that's more in your wheelhouse, Tara, is self-managed super funds. So I'm sure you use these a lot for your Australian clients that are based here. How are self-managed super funds a good idea for non-resident Australian expats?
They're very high risk because where the control of the self-managed super fund moves offshore, then the self-managed super fund becomes non-compliant and is taxed at the highest tax rate. So it's important to note, and this is where we step in and help clients quite often, is there are things that can be put in place prior to ceasing your Australian tax residency, which lowers that risk, but it can't be an afterthought. It can't be, we've already ceased our Australian tax residency, but we've got a self-managed super fund in Australia. That ship has sailed and can be quite costly and needs to be dealt with sooner rather than later. So we need to implement these, not safeguards, but things that lower the risk prior to you ceasing your Australian tax residency. And it's one of those areas where personal behaviour directly impacts the structure. Just off the top of my head thinking things like, I've got one client actually I'm assisting now. They are moving overseas, but they have appointed a legal personal representative in Australia who has genuine, so not just rubber stamping, they actually have genuine control over the super fund and investments, and this client is aware that they can't be an active member and things like that. So there's a whole bunch of things that can be done, but it must be done prior to departing and ceasing your Australian tax residency.
Yeah, absolutely. And if you're just looking to, if you've got a self-managed super fund or wanting to set up a self-managed super fund just to invest in traditional shares or ETFs, then there's probably not a whole lot of merit in setting up an SMSF if you're an expat, just given the risks, potentially 47% tax rate on your fund earnings is kind of a very high risk. Certainly becomes a little bit problematic for existing Australians that are planning to move overseas, that have got real assets, commodities, cryptocurrencies, for example. That's when it may make sense to kind of reach out to someone like yourself and look at arranging or changing that self-managed super fund so that you're no longer the person in control of that self-managed super fund, or at least not making the high-level investment decisions, so that self-managed super fund can still be non-complying. Can still be complying, but even then, there's still that risk. So even then, there's some additional considerations.
It's about lowering that risk. It's starting at a certain point and going, okay, what can we implement? What can we do to reduce the risk of this fund being non-compliant?
Yeah, absolutely. And what about contributing to super? So, I mentioned before, a lot of expats are going to have, superannuation funds back home. They might not be receiving any kind of retirement savings while they're overseas, such as what we have here in Australia, which is the super guarantee, the SG, where 12% of our wages goes into a superannuation fund. Should Australian expats be kind of topping up their superannuation while living overseas?
Yeah, so when clients come to me and I guess ask that question, my default is you need to talk to a financial planner, because that kind of, borders the financial advice.
Yep.
But in terms of, they kind of say to me, what's the tax implications of putting this in? Because as a non-resident, you don't get the tax-free threshold, and there's higher tax rates from $1. So even I have clients who, if in June, they estimate what their taxable income is going to be, and say if it's even $5,000 being a positively geared rental property they've got in Australia, they'll put $5,000 into their super. And we're not just talking self-managed super funds, we're just talking super contributions in general. And that brings their taxable income to zero, so no tax payable. They put the money in the super. It assists the fund, keeping the fund active. Some people get those letters saying you haven't contributed in 16 months. We're going to shut it down and send it off to the ATO if you don't do something. So, a lot of clients utilise that small taxable income, particularly around the property area, to reduce it to nil, but also have those super contributions, which then, it's on-flowing effects of then, their insurances remain in place. They don't lapse because there's been no contributions and things like that. So it's a bigger picture than just the tax. It's really talking to people like yourself around that, But, that's the advantage of having someone like yourself and myself working together, is we can have those conversations and make sure that the client is being considered from all aspects.
Yeah, absolutely. And that's a really fantastic tax strategy that we use as financial advisors, making those tax deductible contributions to super, where the client has some taxable income from their investment properties in Australia. So instead of that rental income being subject to tax at 30%, which is the foreign resident tax rate, you can offset that to zero. The contribution goes into the super fund, gets taxed at 15%. So it's a really nice, easy 15% tax saving on the amount that goes into the super fund.
Yeah, no, that's exactly right.
If we touch on property, so Australian property, real estate, it's still certainly the cornerstone asset for many Australian expats. What are some tax issues that Australian expats should be thinking about, particularly in 2026?
Yeah, look, property is still very popular, but it does come with a lot of tax drag for expats now. So you've got the no tax-free threshold, higher tax rates, land tax surcharges, and it's always taxable in Australia. And as I alluded to earlier, it's no longer the default safe investment to be used from a tax perspective.
Yeah, absolutely. And there were some new rules that came into effect. Well, not new rules. There were some existing rules that were changed towards the end of last year around the foreign resident capital gains withholding. So this is where you're a non-resident for tax purposes, you sell a property in Australia, and the buyer of your property now needs to withhold 15% of the purchase price and remit that to the ATO on your behalf. So that means you're getting 15% less of the sale proceeds. Obviously that 15% acts as a tax credit on your tax record, so you may get more of that back once you file a tax return. But the changes from the end of last year were this now applies to basically all propities. Previously,
Exactly.
there was a threshold where I think it was if the property was sold for less than
700, I think it
750
was.
or something like
Yeah.
that, it didn't apply. But now it's essentially all properties. So if you're selling a property in Australia, need to be aware of those that foreign resident capital gains tax withholding. Because if you've earmarked those proceeds to pay down debts, go on a holiday, buy a house somewhere else, and you get 15% less, that's going to create some cash flow difficulties as well. So something to certainly be aware of as an Australian expat potentially selling property in Australia.
Yeah, no, definitely. And I often get the panicked phone call when clients are overseas selling an Australian property and they see that amount being withheld and paid to the ATO and they think they'll never get it back. And I'm like, well, that's not necessarily the case. It depends on what the actual gain is. And then whatever the difference is, it'll either be a refund from the ATO or a top-up payment.
Yeah, absolutely. And correct me if I'm, correct me on this, but I believe you as a tax accountant can apply for a variation. So where it's quite clear that maybe there's no gain being made on this property, so there's not going to be any tax, you can apply to have that 15% vary to potentially zero in some instances.
Yeah, that used to be a lot easier. Now it's a lot more difficult. It's not something that we really, I just say to people, there's very few circumstances where you can actually do that now since those changes last year. And I just say to people, let's just do your tax return in July and sort it out. Yeah.
Get it squared away then. Yeah, okay.
Yeah.
Let's go to change gears and start to have a chat about some common pitfalls or expensive mistakes that Australian expats can make when it comes to, investing. So what are some really, in terms of just anecdotal, some client examples, have you seen many expensive mistakes that Australian expats have made with their investments?
Yeah, it's generally not just the one thing. It's generally cumulative. It's a combination of a whole bunch of factors. We've got people getting their residency assumptions wrong, businesses still being run from Australia, structures set up with no substance, and which, something that you would see is investing before getting advice. And that's where things get really expensive for people. I guess in terms of the warning signs is if it feels overly complex and you're being taxed in multiple places or you don't understand the structure, that's pretty much a red flag.
Yeah, and I would absolutely second that totally. I think from my standpoint, what I see in terms of some expensive investment mistakes, there are some really high risk offshore investment solutions that are quite commonly presented to Australian expats, usually, in the first year when they arrive overseas, kind of proclaiming to be this tax-free investment. If it's been held for more than 10 years, you don't even have to pay tax when you're back in Australia. All these kinds of things. And I think just be super wary of the terms and conditions in these kinds of products. And as we were touching on before, as a non-resident, you can invest in Australian shares, ETFs, without being subject to capital gains tax with the ATO. So you've already essentially have a tax-free investment vehicle back in Australia in some scenarios, depending on where you're based overseas. But you have complete liquidity and flexibility over these over your investments, which usually isn't the case with those offshore investment bond type products. So that's certainly in terms of what I've seen for prospects and clients that I've spoken with in terms of expensive mistakes that they've made.
Yeah. And the other one I think I see just on that Australian investments is people misunderstand that there isn't an alignment between CGT and income. So just because you're not subject to capital gains tax in Australia doesn't mean that you're not subject to declaring the income on that asset. And that applies for, a foreign tax resident investing in Australia or someone who was living in Australia and becomes a non-tax resident. Things like foreign income, fully franked dividends, distributions, they aren't captured under that net, but things like unfranked dividends and things like that form components of income still need to be declared in Australia, despite you not having to pay CGT on the sale of those assets.
Yeah, absolutely. And that's where you really need to get into the nuances in terms of what you're actually investing in. And that's ultimately going to dictate the tax outcome in Australia. And, we've touched on, flexibility, liquidity. So how should expats kind of build flexibility into their investment planning strategies particularly when their future location is, I guess, a little bit more uncertain?
Yeah. Don't lock yourself in too early. So you want to try and keep things, and again, it's easier said than done in some situations, but keep things adaptable. Make sure that control can move if required. Only build structures where there's actually substance behind it.
Yeah, I completely agree. I think adaptable is the key word there. That's certainly how we build out, investment strategies for our clients. We don't want to be locked into a particular investment strategy. For Australian expats, your circumstances are fluid as it is. All of a sudden you might need to be you might need to move to another country or move back to Australia, and that's going to have implications for your investment strategy. So we want to make sure that it's super adaptable as your circumstances change.
Yeah, 100%.
Just some closing thoughts here for listeners, Tara. What's maybe one thing every Australian expat should review this year as part of their investment strategy from a tax planning, from a tax perspective?
I guess reviewing what your genuine tax residency status is, because as you said, moving around can change that. It's looking at where you actually live versus where your business has been run from. That's probably the other big one.
Yeah, some great tips there. I think from my standpoint, when it comes to investing, as a investor, and particularly if you're making regular contributions to your investments, I think take it back to basics, understand what your savings capacity is. So understand what's coming in versus what's coming out each month. Naturally, there's going to be some variations on that from a month-to-month basis, but you want to be a little bit more on the conservative side in terms of how much you're kind of earmarking for investment purposes. I think that's a really great place to start, particularly if you're wanting to start investing, but then also kind of continue investing as well, because you never want to be in a scenario where you've invested, your circumstances change, you've got an expense that comes up that you weren't thinking about or didn't anticipate, and you've got to sell down investments. You don't want to be selling down at an inopportune time, essentially.
Yeah, 100%.
And how about just one assumption that expats should stop making when it comes to tax or investing?
That personal tax and business structures are separate. They're not. They interlink. You can't have one residency for personal and one residency for a business that you control. It all interlinks, and you need to be very mindful and careful of not only your intentions, but what you're actually doing.
Yeah, love that. I think from my standpoint, I think expats, you don't need to be investing offshore to invest tax effectively. I'm not saying you should not invest offshore, but you don't necessarily need to invest offshore to be tax effective in your investment strategy. And one final, I guess, question for you, Tara. One conversation expats should have before making their next investment decision?
Look, I always say to people, how does everything tie together? Your residency, your investments, and your business. That needs to be assessed and addressed before making your next move.
Absolutely. And I think from my standpoint, you need to think about your investment decisions with a long-term context. And does this investment decision make sense for your future decision, for your future situation, I should say. That was a fantastic discussion, Tara. I might wrap it up there. Where can listeners learn more about yourself and your business, and how can they connect with you?
So the best way to connect is via LinkedIn, Worldwide Advisory, or our website, www.worldwideadvisory.au. Alternatively, contact@worldwideadvisory.au.
Perfect. Thank you so much for your time today, Tara. It's super insightful, and we look forward to having you back on for another episode in the future.
Fantastic. Thanks, Mitchell.
Thanks for tuning in, guys. Thanks for tuning in to today's episode. If you want to learn more about Runway Wealth Management and how we help Australian expats, feel free to jump onto our website, runwaywealth.com, and we're also on all the social media platforms.